The other myth is that the seller will just say no. Seller will say, no, I'm not interested. And that's absolutely not true. The problem is agents aren't asking when they list a property. As market cycles change and get construed and get tight and things get harder, these products become the answer that gets a transaction closed.
It is crazy how many properties actually exchange hands with little to no money down. Creative financing isn't the last resort, it's a competitive edge. It's about helping clients win when traditional paths don't serve them.
Welcome to Signature Buzz, your fast-paced weekly real estate sales meeting.
Welcome back to the Signature Buzz, where we decode high-level strategies for real estate agents and investors who want to think differently. I'm Brandon Roberts, along with my co-host, Chris Bishop. How are you, Chris?
Doing good, Brandon. Back again with my decoder ring because we're decoding things in real estate.
See, I always like to come up with something because then you have a smart aleck remark.
Smart alecky?
Yeah, I was going to say something else, but this is a family show, so we won't. So today we're diving into one of the most underutilized opportunities in today's market, creative financing. So whether you're representing buyers, sellers, or investing yourself, this episode will give you the tools you can use immediately. So let's start with the basics. Chris, when we say creative financing, what are we really talking about?
Nothing illegal. I want to be clear. Nothing illegal. No, I think that, when I talk to real estate agents who kind of want to go to the next level, they've been into those introductory C classes. They've been several years in the business. They've done 20 or 30 transactions. They always kind of want to ascend to the next level of things of information that they can get. What you actually see in our marketplace is there's not a lot of classes on owner carry financing. There's not a lot of classes on financing in general or land purchases or 1031s. We do see a lot on some 1031 exchange coordinators that will come in and actually explain how they work, but they don't actually explain how the deal is set up and how to use it in some cases. So I think today we're going to touch on a lot of these different pieces, but we want to give everyone enough information to make them a little dangerous, right? And I think that as a real estate agent, my investing in real estate didn't really take off until I learned some of these creative deals because, like a lot of people don't have a ton of disposable cash just sitting around in a suitcase. And so owner carry financing or AITDs or some of these others are a great way to enter into the investment marketplace. And I think that both you and I have had experience in that. And I think it'd be a great thing to kind of highlight as we go through the process. And then it wouldn't hurt to talk about land a little bit because share a quick story. My grandfather came to Las Vegas in the late 1940s, right after the war, and opened the Stardust. I was one of the first employees there. And at that time, acre of land, if you can imagine this, an acre of land was about $250 an acre. And so, which $250 now wouldn't buy you a good dinner, but $250 then was a lot of money. And we saw this trend with all of these people that acquired land and held on to it for 50, 60 years. And now they're multi-millionaires. And I just think, for $1,000, I too could have been a multi-millionaire. But even though my family's been here that long, a lot of people didn't buy land because they would have to take that money out of their pocket. And it just was a large sum. I mean, you could buy a house for $5,000, $6,000, right? The entire house.
Yeah.
And so it wasn't a common thing for people to do. But as we see from then to now, there's been a lot of market trends where if you would have understood creative financing, you could have acquired more wealth or more property and things like that and made it work for you. So we'll talk about
sometimes it's just getting your foot in the door there, right? And so like creative financing is anything outside the traditional loan structure, right? So so why do you think this topic is so relevant in today's high rate environment?
Yeah. So, I mean, when interest rates skyrocket, I actually asked my parents who had been in real estate for over 40 years, I said, what did you do in the 80s when interest rates were 17, 18%? I mean, did that I understand the house is only 40 grand, but I mean, what happened? How did people get in and buy these homes that they didn't have that big chunk of down payment? And my parents all said the same thing, is that they would use owner carry financing where they would get the benefit of the current owner's previous interest rate on their loan, which may have been 5 or 6%. And they would put a chunk down on it, and then they would be able to carry that paper. And the owner would get a little piece of the interest on top of the money that they didn't loan out. And so it was just a way for people to jump into the transaction and get what they needed then, and then go down the road a bit until the market changed or things cycled. And I think we see this also when Prices are extremely low. You have a whole level of buyers that get in at very affordable housing prices. And then the prices go up like we've seen in the last 7 or 8 years. Well, now the question is, Brandon, if I hand you a check tomorrow for $300,000, what are you going to do with $300,000? I mean, have a good night in Vegas? I mean, it's kind of like, well, I don't know. I'm going to probably put it in the bank. Well, if you put it in the bank and you get 2 or 3%, now maybe 4 or 5 in a money market, you could not put it in the bank and just write a mortgage to this individual that's buying your house and get 7, 8, maybe even higher percentage rate based on terms and everything else, and receive that every single month. And so instead of getting this huge chunk of money right now, you're getting monthly payments. Maybe it's just interest, or it could be principal and interest, or however you structure it. And you're deferring this down the road. And so it's a much more agreeable term and process, and it makes more money. So that's one of those things we see when it gets to be creative. There's a lot of ways you could put together a package deal for that seller, for that buyer, that provide them exactly what they want without all of the cumbersome processes of going through a traditional loan. Don't tell Shelley I said that.
Yeah. Well, and I've bought many of homes through seller financing, and Shelly still loves me because when it came time to refi I'm out of that, then she
Yeah.
did those loans, so she's fine. She just wants the best for everyone. But what I'm hearing also, or what I'm hearing, is there's great benefit to the buyer to be able to get into a property. Maybe they get in below prime or whatever, or get into a property. Um, but there are huge benefits to a seller as well.
Yes.
One being the added money you can make on your money. And I'm not a tax professional, but the seller might want to talk to the tax professional too, because it could be deferred capital gains tax too, because you're not receiving all that money up front too. So there's a lot of reasons why both buyer and seller would want to do it.
And higher
But
sales price in some cases too. That is
Mhm.
one thing that we've seen. Houses worth 300,000. I think you can find one right now worth 300,000. Houses worth 300,000, and because I'm willing to take a non-traditional type of buyer, meaning I'm not going to get all my money at once, I'm selling it to you for 330. So I'm getting $30,000 more on the sale of the house. Plus, I'm making the interest. Which, if you think about it, if I have this buyer for 10 years and they're paying me 7, 8% interest, that's probably an extra $120,000 I'm going to make over the course of that 10 years.
Yeah.
So I really sold my property for 450. I was able to make a larger impact or a larger return on that if I was willing to give time and energy, while accepting the risk that, yes, that buyer at some point may default on the payment, which in owner carrier financing, that's not a bad thing in some cases, because I could recover everything from the property in theory.
Yeah. And so, let me ask you though, like, a lot of agents shy away from this and stuff. What are the biggest myths you hear about creative financing?
Yeah, I think the biggest myth is that it's not easy to understand. It actually is very easy because, one of the things we hear a lot of times from people getting traditional loans is that they struggle with presenting their profile to the investor loaning the money. So you have a lender who's identified a product, then you have an underwriter who is securing that product for the investor, making sure that you qualify, and they're asking you for a litmus test of things: a blood sample, a high school diploma, your bank statements, your credit report. And so, if one of those things is off, it may cause the whole thing to fall apart. And so, with owner carry financing, we see that a lot of those problems may go away because they're not concerned anymore about necessarily your credit. They're concerned about your ability to repay and the risk, and the amount of money that you put up for that risk. And so, if you're willing to give me $50,000 right now today, and let's say that I'm giving you a loan for $200,000, and we go down the road 5 or 6 years, well, the risk feeling that I have is I put that money in my pocket right now. I'm not into the property as much as you are in that position. So it makes it a much more agreeable. And it is very easy to understand because we outline all of these terms in the purchase agreement and the financing addendum. So we say, here's what it's going to be. Here's what the amortization will be. Here's what it's going to look like in 5 or 6 years. And so it's not that hard to put together if you really read the fine print. And it's much more agreeable to present to somebody than all of these terms that an investor may require to give you a traditional loan.
Right. So owner carry, also known as seller financing, is where the seller acts as the bank. The buyer usually pays them monthly, usually with a note and deed of trust. Let's walk through a simple structure. Say a property is listed at 400,000. The seller owns it free and clear. How would you structure an owner carry?
I would give a down payment that's agreeable, as little as I can if I'm the buyer's agent, and as much as I can if I'm the listing agent, right? And so
What do you typically see down
I
payment
see
wise?
I see 10% a lot of times in an actual um, owner occupied scenario where that buyer is going to live in the property. I've seen 10% work. I've seen 20, which is traditional for a regular loan. I've seen all the way down to 5%. Sometimes I've even seen 100% financing with a higher interest rate. So all of those things are possible. I've also seen principal only, interest only, where they're only paying the interest on that for 5 or 6 years. Maybe that the buyer had a bankruptcy and they need to wait 2 years to be able to qualify for a traditional loan. So they just want to do it for that short period of time. There's a lot of different ways that those could be structured, but usually about 10% on average for many of the ones that I've done.
Okay, and usually I've done 20, 25% personally, and a lot of it, if I was representing the seller, what I'd be looking at is what's that cost to take that property back if you had to go through foreclosure,
Yeah.
and then you obviously have like commissions possibly have to be paid in your expenses, and looking at that and making sure that you would come out ahead of the game in that regard. So if you put yourself in a strategic point as a seller coming on the front side to get enough money up front, you're probably pretty good. Okay, so let's move to like interest rates in the term.
Yeah. Well, real quick before we move on, that is a good point because if you're finding a property in the MLS and there's an agent already structured with it, then the down payment has to be enough to cover all the closing costs that they're going to incur. And I have seen buyers and I have seen sellers come out of pocket to cover those closing costs, but it's not very traditional. The best case scenario is that you're out there looking for listings or possible clients, and you come across one and you say, okay, no problem. I'll just buy it from you. You be unrepresented and I'll buy the property. And then I've eliminated a big chunk of the closing costs because I'm going to roll all this back into my property. So I think that's kind of scenario one. When it comes to interest rates, that's all about the risk assessment, right? And so right now, if the interest rate in the marketplace is, let's say, 6%, it's either going to be a large down payment and I'm going to get a more agreeable rate, like I'm going to get 5%. I've seen that happen many times where I'm willing to actually undercut a traditional loan rate so I can bring you in and get that $100,000 or $50,000 down payment. And for the seller, I mean, it's still good money that they're earning. And then I've seen the other side. I've seen it where I'm putting down less and my rate's going to be 7 or 8%, maybe as high as 10, but I can't get another loan product anyway. So yeah, I'm willing to pay it because I need that house to live in. I need the interest deduction. And when you think about that, the biggest write-off for an individual consumer is usually the interest on their mortgage. And so even if I had a 7 or 8 or 9 or 10% interest write-off, I may be able to write off a huge chunk of that on my taxes. So that could be another benefit for me financially.
Yeah, and then the other thing is most of the time the seller financing deal is not done for a 30-year term. Usually it's a period of time with a balloon payment to force them to refinance at a certain point. So by making that interest rate a little tighter or higher, would encourage them to refinance the property and get you out of it. But sometimes the seller doesn't want you to get out of it because sometimes there's some tax ramifications on their side, and they're the ones really pushing for that. So there could be possibility of a prepayment penalty, right? Or being able to pay it off.
Yeah, I mean, if you think about it, and the investor or the seller who's in this position, if I'm getting 7%, say on $300,000, well, I'm getting $20,000 plus a year in interest, and I want to do it for a period of time to recover the costs or the profit margin that I'm looking for. And so, yeah, a lot of times we'll see a prepayment penalty if they do it before 3 years or 5 years because there's a profit margin they want to recover. Now, we've seen this done several ways, and there's a lot of ways that you can structure it. I could have a 30-year term with a 2, 3, 5, 7 year balloon payment, meaning that the loan is amortized over 30 years, but I have to pay it off within five, or that balloon payment comes due, and then they can proceed just like I defaulted, basically by not making that balloon payment. They could proceed and then foreclose on the property because I didn't make the entire payment. But they do that to make the payment more agreeable. Like they want to compare it to market. And so if I say it's only a 15-year amortization, then that payment's going to be double what everyone else is expecting. But I've also done that in owner carry deals where I've gone in and said, you know what? It's a piece of land. I only want it for 10 years. And so we'll do a 10-year amortization. I want to have half of it paid off. And in 5 years, we'll do a balloon payment. It's all about the desire of the parties and what they want to have happen at the end. But there's no lender to say you have to do this program. So it's up to the parties to figure out what they feel good about.
And that's the beautiful thing about it, right?
Yes.
You're going to structure something that works for both parties. And a lot of agents get a little bit nervous about this, but I know here at Las Vegas Realtors, I mean, they've done a financing addendum and it asks you all these questions. It walks you through this process. So it's a negotiating point. But a balloon payment, typically I see around 5 years or so. And yes, amortized over a 30-year period. It just means that it would take 30 years to pay the thing off, but you're not going to get to that point because what's due and payable in the 5 years has to either be paid off or refinanced.
I've actually seen, and I have one right now where it is an actual 30-year term. Like they agreed to a 30-year term. They're okay with it. It's a solid investment firm that wants to make that interest on a long period
Yeah.
of time. And they said, yeah, no problem. We're not able to get traditional mortgage clients like a regular bank. And so we're able to take our money and invest it for that purpose. So we think this interest rate is a great rate. And we know that the property collateral is enough sufficient to do it. So there are instances for a primary occupant to find a property that will give them a 30-year mortgage on a non-traditional product like this. It's just rare. Like it's probably 1 out of 10,000 that hit the market. But the other myth is that the seller will just say no. Seller will say, no, I'm not interested. And that's absolutely not true. The problem is agents aren't asking when they list a property. And I've always looked at it as a funnel, right? If I say my client will only take cash, then I've taken the funnel of prospective buyers and I've shortened it to this. If I say they're going to take cash and conventional, I've opened it to this. And if I say FHA and VA, it's now this. And if I say owner carry, now I have my arms completely open for everyone in the marketplace that could come and buy it. And we haven't even talked about lease options and other things. But as market cycles change and get construed and get tight and things get harder, these products become the answer that gets a transaction closed. And so
Yeah.
I think the other thing is if I'm a listing agent, I should be very open to explaining this to my client, because if that client's in that situation where they don't know what they're going to do with the money and they have no plans, I've just given them a great benefit and it shows my value as their agent.
Exciting thing right now with where our market sits today, I think it's prime for this kind of financing and this way to move property. But let's talk about this. Okay, so the seller becomes the bank, so to speak. They're carrying the note. Servicing options, like when I get a loan, I pay my payment to a servicer, right? That takes that. They take care of the taxes, the insurance, usually the payment, distributes it everywhere, that kind of stuff. Plus, sends the tax documents at the end of the year. What options are there for a seller financing deal for servicing?
It's actually the same. So you think about it, Wells Fargo has their own servicing division that does all of these things. And the investor wants to make sure that lienable items like your HOA or your insurance or your taxes, depending on your credit worthiness, are impounded to make sure that that payment's going to be made. And remember, during the default period, when we had all of these loans defaulting, there were no insurance on properties. They were behind in their taxes. There were super priority liens. And so these banks decided that we don't want to see that happen again. And so a lot of times when you get a traditional loan, they will dictate what impounds you have to have. Well, the same thing works in owner carry financing. And the nice part about it is you have an agreeable party on the other side that all they want to make sure of is the payment gets made. And so the last thing you want is to be 3 years in and you've just been paying the seller and now there's a dispute. Like, oh, I think you owe more principal, and oh, I don't think you made those 2 payments and I don't have any proof of it. I didn't keep records and I lost my record book. So you always want to use a servicing company so it eliminates future disputes, right? It's a nominal fee. There are a few $100 up front. Usually the parties will share in that. And then the buyer usually will cover the monthly cost. It's about $10 per impound that you put together. And so for 40 or $50, there'll be no arguments. And you said the most important part is they give you a monthly reconciliation, just like a mortgage statement, showing here's what you paid and here's how it was applied. And then when you go to pay off that mortgage, they're going to give a reconciliation to title and say, here's what's owed, just like your mortgage would with a payoff. And they're going to account for your impounds. They're going to say you have $968 in this account that would have gone for future payments. And so I always tell my sellers, like we want to impound taxes. We want to impound the insurance on the property, make sure it's paid. We want to impound the solar payment if there's a solar being carried on it to make sure that that's covered. And yes, the HOA, because these are all things that are lienable. I've even seen them go down all the way down to tax, like sewer and trash, because those are also lienable. It can be any way that they want to structure it. But the nice thing for the buyer then is they're only making one payment for everything. And they get a nice statement and everyone knows it's being handled. And I think that's the security you want to see every single month.
Yeah, I agree. And I've done it both ways. I've done it where the seller takes care of it and the other, and I prefer the servicer for sure. And there's some great ones out there. Um, and you can always reach out if you want some recommendations.
There must
Um,
be 50 companies that do it. Title companies don't do it anymore since the mortgage crisis. But I know that we have several in our marketplace. There's several internet-based ones. There are some attorneys that also do it. That they will take those. They're a little bit more costly, but they'll take those monthly fees and go through it. But they both work.
so I'll share a scenario that worked out real good for me. Is I sold a property to a gentleman years ago, and this and he buys property and he rents them out. And as we were going through the process, we put it on the market for rent after he bought it, and it just wasn't renting.
Yeah.
And it was like, we got to reduce the price, we got to reduce the rent. And he got a little bit nervous and he says, Brandon, I think I need to sell this. And keep in mind, we've only had this thing for less than 90 days. And he's like, I think we need to sell this. And I thought, I said, would you be willing to carry the financing? And he goes, what do you mean? And I said, well, you would get the payment just like you would have with rent, right? You would made some interest off it over a period of time. We do something with the 30-year amortization with maybe a 5-year balloon. He said, well, put out the numbers. Let me see what it looks like. So I did. And long story short, he sold me the property 20% down and went through the process. He didn't have an interest rate because he pays cash for his properties, but he charged me about 5.25, right? Which was fine. But then what happened is the rates went down to below 3.
Yeah.
And when they went down below 3, 2 years into the thing, I refinanced the property and I've got that mortgage at 2.8. And it's a tremendous rental. The interesting thing was he wanted out of that property. I took it. I had to lower it down clear to $1,600 a month to get it rented. I found a renter that would rent it for 6 months because they were building a house. And then after that 6 months, I've never had a problem renting it above 2,000. And
Yeah.
so it was just that period of time that it happened that the market was slow for rentals in that area for some reason, but it's turned out to be a great investment. And I was talking to him the other day and he goes, man, I should have hung on to that house because the equity in the house is huge now too.
Yeah.
So it worked out for him. He got out from under it. He bought other properties, but it really worked out for me on the buy side of being able to go out and solve a problem and get this home sold. And so what's a good way to explain to sellers who are skeptical? Because that is typically a thing. It's the uncertainty or the unknown, right? And so you're an agent, you're sitting down with the seller and maybe you've got someone like me on the other side that's brought you an offer. How do you present that? How do you talk them through it?
So first off, you hit on a big point, and that is the fact that all of the maintenance items of that property now go on to this purchaser because now they're the owner of it. So if the AC goes out, it's the purchaser's problem. If the utilities need to be, it's the purchaser's problem. I, as the mortgager, now don't have to worry about all of the maintenance and upkeep of the property, HOA violations, the roof is leaking. That's now all onto that purchaser. And so a big chunk of the maintenance costs that a landlord would have every single month have now been taken off of them. And so now all they're receiving is principal and interest every single month. And all of the payments that are related to the property, the taxes, the HOA, this trash and sewer that usually a landlord would have now all been taken off of the owner and moved to the purchaser. And so when I'm talking to an investor that has been a property landlord for a long period of time, the usual headache is, I'm tired of dealing with HOA violations. I'm tired of dealing with repairs. It's eaten up all of my profit. By them moving into the mortgager position, they've now eliminated that whole concern, and now they just receive a check as long as they make the payment. And so that becomes very, very agreeable to them after years of dealing with that. And I've seen it happen a lot of times with what we call mom and pop investors, people that were forced landlords where they didn't really want to have that property or deal with it. And they have a fear of what could happen. Like, oh my God, it could burn down, or oh my God, they could flood it. Well, now all of that onus goes on to this purchaser because it's now their home, their property. And they take better care of it because it's their home and their property, right? I have noticed that in owner carry financing deals where a tenant would go in and turn the AC down to 68 in the summer, the person now owning that property will turn it down to 75 because they're concerned about the lifetime of the AC unit now because it's their AC unit. And so a lot of those issues being taken off of the owner now make it a very agreeable reason why they would want to do it. And it's also a profit margin difference, right? If I'm just receiving principal and interest and I've eliminated the expenses, I'm now going to make a much higher return on the investment I made, is why your investor was agreeable to do it. they could get 5.25 in a marketplace where we were probably only seeing a 4% ROI. And so that's a very much more agreeable situation. And you put 20% in his pocket. So all of those things led to why I would say yes, because the risk was way less than the rewards I was receiving. And so that's usually how I present it: is I highlight, here's all of the value benefits that we're going to get, and here's the risk that you're going to have on it. This is very minimal compared to what you're giving up. Why wouldn't you do this? The only reason why most owners won't do it is they need the funds from that property to be able order to do something else. The other thing I've had is I have owners in situations where they just bought a property. Great example. They just bought a property and now they've been deployed someplace else. They're active military and they don't have a choice. They got to go. And now they're just freaked out. Oh my God, I got this house that I'm not at anymore. How am I going to get it rented out? How am I going to make a mortgage payment? And so in those situations, we have what we call an AITD, which is an all-inclusive trust deed, where they wrap the deed around everything that's owed on the property, and they're able to make those payments through an impound with the servicer. And it's a great answer for that type of seller on what they need to do. You can actually search in our MLS here in Las Vegas for AITD financing deals, and it's just another answer to another scenario that we have there. But again, it's all the risk versus reward factor. Now I'll have someone living in my property who's taking care of it, who's going to make the payment, and I don't have to worry about it. That's a huge relief factor for a lot of people.
Yeah, so I'm glad you brought that up. So, like an easy seller financing deal is when the seller's paid cash for it, owes nothing on the property. But if
Yeah.
there is another loan on the property, then they're basically wrapping that. So they're financing the rest of the equity around the loan, and that loan gets paid. But one of the big problems with an AITD is a due on sale clause,
Yes.
right?
As soon as I sell that property, I have to pay off the existing mortgage. I don't get to keep that difference of the money. And there's an added risk factor that, technically, most loans in some cases are non assumable. And if they were assumable, they would have to be assumed through that bank. An AITD doesn't actually assume anything, it just pays the payments. And so the risk to the seller now is the fact that that bank could call that note due. And now they have a buyer who technically owns the property and they're in the middle. So that means they may have to pay that off. They may have to secure additional financing. It kind of ties those parties together for a long period of time that no matter what happens, we're going to have to work it out. And that's some of the risk of, well, should I really do this? Well, if you had a $500,000 mortgage that's $3,800 a month at a 7% interest rate and you have to leave, you're probably willing to do a lot of things to make that payment happen. And so, again, it diminishes the risk reward factor on why I would participate. And we do see a lot of those in the marketplace. I mean, they happen quite often. We probably, here in Southern Nevada, I got to believe there's probably 10 or 15 of these minimum a month that are probably cycling through the marketplace because of those scenarios. If you remember, you and I, years ago, and I think it was Inman in San Francisco, there was a lady who got up on stage and her entire business model was she went to people that were in fear, like they were fear of foreclosure, fear of short sale, fear of payment, fear of maintenance. They had a rental property they didn't know how to manage. They had a tenant that was beating it up. And all she did was step in, no money down. She would step in and take all of the fear over from them. And she would take over the property and she would just remanage it and maintain it. And they would sign it over just like they were selling it. And she was doing $1 million a year in profits from deals just like that all across the country. I was floored. I couldn't actually believe that people were just giving her these properties, and it's because of the fear factor. Some people can't handle the emotional stress of dealing with a property that's not where it needs to be, and that was her whole model. It was crazy to me, and I thought, why am I not doing that?
It is crazy how many properties actually exchange hands with little to no money down.
Yeah.
But it does happen, and it's shocking to me. And then the due on sale clause, I think as long as the payment's being made, a lot of times the bank's okay. But there is that possibility because of the clause in the contract that it could be called due at any time, and that would obviously put both parties, both buyer and seller, in a damaging position because that
Yeah.
buyer, if that bank foreclosed on it, would lose the property and all the money that they'd put in. And so then you'd be looking at lawsuits, stuff like that. So it's important that if you're going to do these, that you make sure that you, especially at Signature, you get with one of us brokers to make sure that disclosures are put out. Everyone understands all the risks and everything that come along with that.
I do want to highlight one
possibility.
reward, though, that people don't think about in this. And so, in this scenario, let's say right now in the marketplace, I purchased a home for $350,000 at a 3% interest rate. And now, 5 years later, the home is now worth $550,000, right? And I get a prospective buyer that wants to buy the house that's owner carry. Maybe they have a tax lien, or they haven't filed their taxes, or they don't have enough down payment, or their credit scores low, whatever the reason is. But they do have money, they have cash, and they have ability to repay. And so they give me 20% down, which is $110,000 on this deal. And so I'm really close to what I currently, owe on it. And they're going to be at 7% for the entire amount. I'm at 3% for the amount I only owe. And so now I'm making 4% on the money that I didn't even come up with. It was the money from my bank that I borrowed. So I'm making 4% on that. Plus, I'm making 7% on my equity. And so when you think about that, 4% on $300,000 is a tremendous amount of money to receive monthly. I'm acting just as a bank would by escalating the rates based on the marketplace. And so you think about that reward factor. That's one of the reasons why I probably do it. And my bank's getting their payment every month, so they're happy, right? All of the cost of the property are being paid, so everyone else is happy, and I don't have to do any of the maintenance or the upkeep or anything else. And I got everything I wanted from the house, and now I'm getting those payments. And yeah, 3 or 4 years from now, that buyer is going to want to refinance, get a better rate. They're going to pay me off, they're going to pay my bank off, and they're going to take care of all those things, and it's out of my hands. And so that is the whole reward factor of why someone would do it in that scenario.
Yeah,
Right.
so let's shift gears a little. I mean, that's changing title into a seller finance deal where we're changing title into the buyer's name. The seller becomes a lien holder, and they have a trustee that secures their position. There is a contract out there called a land contract. It's not for land, but it actually is agreement to sell the property and to make payments and everything. And you can do this through processor as well. But the title isn't actually changed. The seller maintains title, and the buyer gets equitable title, so to speak. It still can be recorded that it's there, but the foreclosure process on that is different. You're treated more like a renter when you didn't make the payment. So there are options there too. The other one that I get a lot of questions on, and you probably do too, is lease options.
Yeah.
Um, I've never been a fan of a lease option. What's your take on them?
You know, I agree with you. Like, I have never been a fan either. And when I look at products like this, I look at, what's the need from the consumer that I'm trying to help. And usually the reason why someone exercises a lease option is they believe right now is the time to buy, and property prices are going to go up. And so I exercise an option to say, I'm going to lease the property at a rate I can afford and a payment I can afford. Usually a portion of that lease payment goes to the down payment, or it goes to the principal of the property to make the price more agreeable. But I'm going to lock in a price right now. And that's what I'm going to put the option money up for. And what's interesting is, agents can still earn commissions on that as long as the option money is enough to cover those costs. And so I had a gentleman who lived directly next door to me, and in a property that I had bought. And when I met him, I said, how long have you lived there? And he says, oh, I've been leasing the property for 3 years, but I have an option. And I said, oh, that's great. Well, unfortunately, prices had tanked 30 or 40%. And so his option was 30, 40% higher than property is worth. And he basically lost his $25,000. And I remember thinking, that sucks, right? Like, it's one thing if I was the owner of the property and I was getting the value of knowing I owned it and the write-offs and things. He wasn't getting any of that. And he lost 25 grand, and he had fixed up the house. And so he's out all of those things. There's no reason he should buy it at all, because the price he'd get optioned at is far above what it is. And so you got to be very cognizant in option deals, what the return on value is, what the market's doing, and where it's at. But it is better than just leasing a house and paying someone's mortgage, right? You do have some type of value in the property, but make sure it's the right value. And, for the agent participating, if there's, not enough money in the deal, you ain't getting paid. And so you got to be very cognizant of what you're structuring as well.
Yeah, because likelihood of it coming together in the end is slim. It can happen. I have seen it happen all the way through, but a lot of times they don't exercise the option. And so, yeah, you want to make sure they're bringing in enough money for that option money. The other thing is it ties up that property
Yeah.
that owner can't do anything with it for that period of time of that option.
Yeah.
It can really tie the hands of
A
the
lot of
owner of the
times,
property.
I've seen them when an owner could be in default. Like, there's a buyer that wants to buy it, they're not ready to buy it. The owner has a need for the money because they can't make the payment or something like that. And so a lot of times this option money comes in and saves the day and saves the property from all of these things. And so that's why they're in it. But I have seen a lot of disputes and auctions because now the property has gone up in value $300,000 or $400,000 from where it was. And this owner's thinking, oh, well, I want some of that money. Well, it's not your money anymore. You sold an option because of the need, and now it's this person's. And I always see those end in some type of lawsuit or issue, because it depending on how they're done, you are writing a contract for a long period of time, and people don't like that in some cases when it doesn't benefit them.
Yeah, I've structured not as lease options, more as a lease purchase, and
Yeah,
what that means is actually having a purchase agreement with a very far out closing date. They're putting earnest money down, going through that whole process, but they've agreed to buy it at a certain timeline.
same
Um,
thing. I like that
yeah,
idea way better. It makes more sense.
yeah. So there's lots of options out there, but let's switch gears to land. Land
Yeah.
is notoriously hard to finance conventionally. What are some smart ways people are getting land deals done?
I
So
do this a lot. The
yeah,
last year, I've done about 5 of these just for owners and clients that I have. I actually got to double in a deal where I actually had a buyer who could pay complete cash for the property, but the owner wanted to do owner financing, and so they actually carried back 100 grand. It was a $300,000 half-acre lot. My client put down $200,000, and the owner carried back 100 grand at a very agreeable interest rate. I think it was like 5% for a few years, like 3 years. And the reason why my buyer wanted to do it was it preserved some of their capital. And the reason why my seller wanted to do it is it deferred some of the income from the property and it gave them that interest so they could make a little bit more money because they weren't going to use all of the funds. It's the hardest part because land traditionally there aren't any financing options for it. There are some banks that will do 50% financing very easily. Many large lenders will. They will do construction loan financing. So you buy the land 100% with the down payment. You pay for it completely, and then you roll the land into your construction loan. The bank looks at it as your down payment, and so like you're putting 300,000 down. You build a $900,000 house, and now you're in it for a total of 1.2. Well, you've already made that down payment, so that's how they look at it. I've done that. Um, there's also some banks here in Southern Nevada. America First is the only one I've found that will offer up to 80% financing over 3 different term cycles. So you can get a 10%, a 10-year loan, a 7-year loan, I think a 5-year loan, but they're the only bank that I've seen that will offer anything that high. But it's a process. It's a heck of a process to go through financially for the buyer. And a lot of these times, it's just answering the question, I want it for a short period of time while I do something with the land. Now, why would someone buy land this way? I have a client in 1988, maybe it was 84, I don't remember. It was 40 years ago. She went out in the middle of nowhere, in the desert, middle of nowhere, and guy showed her a piece of 5-acre parcel of land. It was $78,000. She had plenty of money, for a 20% down payment, and so he carried about $50,000 for the course of like 10 or 15 years. She paid it off. Every payment, every month ahead of time, paid it off. And she held that land until 2018. And we sold it to a builder for $3.5 million. That's the best case scenario I see for these all the time is they purchase a property for a reason to speculate on what it's going to do, the value of the land. And there were many times where she could have sold it for more along the way, but she held and held and held and saw the values drop dramatically and then saw them come back. But it was a way for her to get in and purchase that piece of land that now is paying for her retirement and everything she wants. And so it's a great opportunity for an entry level investor to get in on something that could provide a long term value because the seller's willing to carry it because they own it all usually outright right now. It's all theoretical money to them anyway.
yeah. So you've probably got a lot of stories of deals like this that you put together, but I don't know if you can share one. It seems to me you had some land and some townhomes, partnership with the builder. Can you talk about that, or is that confidential?
Yeah. So after 8 years, I just wrapped up the deal yesterday, which is funny. So that same owner I was just telling you about, instead of just selling the property outright, we found a home builder because what she wanted to do was she wanted to take a piece of land that generated no income. It just generated equity. And she wanted to turn it into income producing assets that would provide monthly payments that she could utilize again for retirement or whatever the need was. And so what we did is we found a builder who wanted to build on 5-acre parcel. They wanted to build a townhouse community. I think it was about 80 townhouses. It all fit on the plat map. And so instead of just taking the money, we created a deal where the builder came in and built their 80 townhouses and gave her the value of the land in townhouses. It was an unbelievable, it was more like a trade than it was a transaction. And trades are another form of this that we go through, but it allowed her to have what she was looking for and be brand new and be a cutting edge product that's just hot and hip in the marketplace. And I've now seen this type of transaction several times where, maybe the owner doesn't just want the cash. I mean, everyone gets so fixated on here's the money, but what am I going to do with it? Well, she was able to get 10 rental properties that while they were being built, by the way, those rental properties escalated in value because builders phase product, right? So she had a pricing before it was ever set up. And then they did the first phase, second phase, third phase, fourth phase. By the fifth or sixth phase, she's gotten all the value of the builder phase pricing. And now she's ready to then rent out these properties. And now it's been 7 or 8 years, and those properties have gone up in value like everything else in the marketplace. And so it's just another example of how you can put a deal together that's not traditional by having some creativity. Like if you don't have imagination, go out and get one, because it will help you find transactions and income and commissions that you never thought possible. And I've also done the opposite. I've gone out and found a seller with just a parcel of land in the middle of nowhere that they've held on to for a long period of time. And I said, what if we went and built some spec homes? Like you could fit 2 1-acre estates on this property. You have the financial ability to do it. Instead of just selling the land for $3 million, how about if we sell 2 $3 million homes? And I've gone out and actually connected them with a builder. Some builders, small builders included, will actually pay you a finder's fee for finding them a partner to work with on a joint venture. And that's what it literally is, a joint venture. And they will then work with that owner, construct it. I brought in a third-party lender to help with the financing on it. I mean, all of those are things that you could do versus just selling a piece of land, which is hard, by the way. Not a lot of people have $3 million in cash to just go and buy that land. You're more likely to find someone who can get a loan to buy that luxury home than just to buy the land itself. So it's just another way of being creative on that deal.
This stuff excites me. I just think, when you can put deals together that aren't traditional and that may never happen if you don't go out and get some creativity. I don't know where
I'll
you buy
share a
that.
story with you real quick that is a good story. So about 15 years ago during the market crash, I was a REO agent along with my dad for Bank of America. And I had a listing that had been a brand new home, had sold for $300,000 from the builder in 2007. In 2010, when everything was really coming back from the crash, it became an REO, real estate owned property. The bank was selling it for $89,000. I mean, this home had hardly been lived in. It was only a few years old. And I had an investor who came in and utilized a product called VA Vindy financing, which was offered through the VA, and they offer it around the country except in Las Vegas. They don't offer it here anymore. They did. And it allows a primary investor to buy a property with 0% down if they're going to live in it and 5% down if they're going to be an investor with it. And you can get them across the nation right now. So if you haven't looked into it, definitely do. And so he bought that property along with 12 other properties from me. And over the course of 5 or 6 years, I managed the home for him. He was a great property owner. He was active military deployed, buying properties, across the internet. And the property got up in value to about $200,000. And I was in a better position, and I decided that I wanted to buy some investment property. And I knew he owed very, very little if the loan wasn't almost paid off. But I knew he had like a 2.5% mortgage on the property. And so I called him up and I said, "Hey, have you thought about selling?" He says, "Absolutely." And I said, "Would you consider carrying paper on the property?" And he goes, "Well, I don't really know what that means, but if you explain it to me." And I explained it. And I said, the interest rate, if we did it, would be 5%. 5% versus your 2.5%, and all of the equity. And the problem is now we're 200. He's got $140,000, $150,000 in equity now. I said, "You'll be getting that type of money out because you couldn't get that in a bank at that time." And he goes, "Yeah, that sounds great." He goes, "How much can you put down?" And I said, "0. I can't put anything down, but I will make the principal and interest payments. I'll take over all of the expenses of the property, and I'll give you $1,000 a month in additional principal for the term of the entire loan. So at some point within the next 3 or 4 years, you'll get $30,000 or $40,000 from me in additional principal that will be considered that down payment. Would that work for you?" He says, "Done." So now I bought a property, and all I had to pay was the closing costs, which were $4,000 or $5,000, and I made that additional $1,000 payment. A couple of years go by, and I'm tired of making the $1,000 payment. And so I found another investor who came in and refinanced, not a bank, but another investor who transferred money from their other asset to this property rewrapped a new loan for me that got rid of the $1,000 a month extra, and they still did it at 5%. And I was able to cycle that property into two other properties, as you go down this story. And I started with zero out of pocket as the down payment, but I built equity in the properties as they went up in value. And for me, like that put me as an investor in the marketplace to start earning wealth. And there's opportunities like that all over the market. You just have to be looking for them.
Yeah, I want you to find me deals like that, Chris, please. So let's go back to land a little bit. Importance of due diligence. I mean, zoning, water, power, septic. I mean, you can't just find a piece of dirt and go build, right?
No, it's about the questions you ask the owner, right? Like I spend a lot of my time when someone wants to buy a piece of land or someone wants to sell a piece of land, and I ask 100 questions. Like, what is it you're looking to do? What's the history of this property? What have you done with it? What utilities have you put in? Have you had any problems with those utilities? Have you had any well certifications done? When's the last time the well was used? Has it ever been pumped? Like, if you don't ask all of those questions, how can you articulate what someone's buying or what someone's selling? And then the problem is that you have multiple utility divisions who don't make it easy at all for you to find information. I have to get on the phone. I have to make friends with people at these utility companies so I can call them back. I have to document every piece of this process. So I called Jan at the water district. Jan told me this. I talked to her this day. Here's her phone number. And I email things like that to the buyer or seller, whoever I'm representing, to say, here's what Jan said. Why don't you go and confirm it as well? And I think what gets agents in a lot of trouble is you see on a land listing all the time, utilities are 0 to 1,000 feet. Like they don't know where they're at. They just put that because they figured, why not, right? That's not adequately representing your client. It's your job to go and verify these things, not confirm, but verify, and then provide the verification info to the consumer so that they can go and confirm that it's the truth. Because once they get there, and if my intent is to build a single family home and that property is zoned commercial, then I can't do that. And now you've let me spend my money on something I can't buy. If you find out that there's a moratorium on wells being dug on the property and there's no access to a water line, it could cost $80,000 to bring a water line 500 or 600 feet. And so you're putting the consumer at risk if you don't know what you're doing with these things. That's why we have a lot of people here at Signature that are willing to help you. But it's all about, accrual of information and making sure that you're asking those questions. I've had properties with soil issues that we wouldn't have found out unless we asked. I've had properties where we were actually in contract and the city and the state changed the process for septic systems. We've been through hell finding those things out. A perimeter wall, like someone buys a parcel and they want to put a wall up. A wall could be 70, 80 grand. And you only paid 150 for the parcel. And so like there are all of these expenses that come up when someone's actually constructing a home or the value of it. In reverse, I have a 20-acre parcel and I want to chunk it up. It costs money to subdivide a property. You've got to go get plans. You've got to go get diagrams for it. You got to present it to the council or city who controls it. And so you've got all these municipalities that cover areas that you've got to fight within to find out who has control over what. And so it's a dynamic that takes time and energy to do for sure.
Yeah. So land sales can be a great place to put buyers and stuff like that, but it's also a great place to go out and get some listings, right?
Oh yeah.
And start to compile some projects and stuff. But how would you approach a landowner who maybe inherited the property or they don't want it or they've had it for a long time? It's just kind of been sitting there.
So you'll notice as you drive through the Las Vegas Valley, you see all of these vacant parcels in the middle of developed areas, right? And so one of the first things that you should know is that a lot of the land within the valley could be BLM, Bureau of Land Management. And what happens is, BLM releases land as the city grows. And we just had a big fight right now to try to get more land released. If you remember, there was a senator from Utah that put into the big beautiful bill a piece for land release in Nevada and Utah. And that just got pulled out of it. And so land constraints are one of the reasons why we don't have affordable housing. But then you see these lots within the valley. Some of them are speculative lots where people bought them and they're still holding them for the last 30 years. Others could be, like we said, government land that hasn't been traded yet and you can work to get that done. Or it's undeveloped land that has a future purpose that no one's figured out. All I had to do to find available listings was to go into our MLS, go into the tax record and do some research. I've acquired a number of listings out here in the Northwest. And all I did was I went over the tax record and I hovered over the parcel and I found the owner's name and their address, which is listed there. I put it into Google. I put it into whitepages.com to find their phone numbers. And I picked up the phone and called and I said, hey, I'm a real estate agent. I work in land development. I'd love to list your property, spec it out to some builders or some owners. Is now the right time for you to sell it, or have you considered it? And what would you take for it? And many times, like they're like, well, yeah, I'm good as long as I get X. And their realization of now X being the actual price versus 6 years ago when it wasn't has happened a lot. I've had others that are just completely like, no, I want $30 million for my $300,000 parcel. And like, no, not today, but I'll call you next year. Right. But it's the whole thing of creating a database of prospective sellers who have no home inspection to deal with. They don't have a property that's there. It's just dirt, right? They can't do a whole lot with it. I guess they could shovel it up, put it in buckets and take it home. But like there's not much to do with it. And so we've seen builders enter the marketplace that are still building like crazy. That whole area I was just telling you about, a lot of big developers have come in to build $1 million luxury homes on these parcels that before no one was looking at. And so it's just about going where the market is and creating your own marketplace. And there's not much competition. That's the best part. I mean, I had these people say, "Oh yeah, I get letters in the mail every month," but no one had called them. No one had physically picked up the phone and done it. I have one guy that I email with every single month about his 5-acre parcel, and I'm like, "Hey, is this the month?" He's like, "Oh, not this month. Check next month." And I'll keep doing it as long as it takes until he says, "Leave me alone," or "Sure," because that's how you generate business, right?
Yeah. No, it's good. These are this stuff's exciting to talk about. I got an idea though. I think you probably should create like a CE class on creative financing.
Yeah, I'm working with ChatGPT on that right now. And I put some stuff together for it, but like a great example of that is water rights. Like in land sales, you deal a lot with water, because water is the name of the game for everything. If you have no access to water, you got nothing. And so I've never seen one CE class that had anything to do with water. And that's one of the goals I have this year is to create that class by getting some experts in that field to actually provide value for it, because I think agents really don't know about it. And we've seen a lot of things happen these last couple of years from the water district and the health department about water preservation. And so I think it's probably one of the biggest topics we're going to have as the years go by, because that's the first question every consumer asks. You're going to run out of water soon? They don't know that, we have hundreds, if not hundreds of millions of gallons of artesian wells under Southern Nevada that are in different basins that no one ever talks about, but they're very protective of it.
Yeah. So any other items or things you want to talk about with land or creative financing before we wrap up?
Yeah, I think one big topic is 1031 exchange, and we didn't really touch on it a lot, but like all through my real estate career since 2003, 1031 exchange has been part of my business, because as a certain amount of money is made, my goal is to cycle my investors into better, more productive product. And one of the ways to do that is exchanges. And if you buy owner carry financing or anything like that, you will be exchanging it, hopefully, if it's an investment property, for more property. And it just means that, I built enough equity that now I could buy something better, get a larger owner carry loan. You can actually 1031 from one owner carry loan to another owner carry loan. I just did it. And it's a great product to be able to increase the value of these investments that you've made. So spend a lot of time learning about it. There's multiple types of exchanges. It plays a big role in land sales. In the deal that I gave you the example of, we actually didn't do an exchange because it made more sense to do it a different way. But most owners are always going to want to exchange from one piece of land to another piece of land, something that's providing more value, or from one piece of land to a commercial building or something like that. But they're going to want to defer those taxes because it's a large chunk of money. You sell something for $3 or $4 million, you don't want to give the IRS $1 million. You want to defer that into another parcel so that you can receive the rewards of that value of rents. And so it's something you should definitely hone in on and take classes in.
Yeah, I think as a realtor or real estate agent, the more you know, the better you can service your clients. The more you're genuinely curious about the goals and about your clients, and the more questions you ask, the more opportunities that you can offer to them, and hopefully get them um, doing more transactions. It's not always about just taking orders, just looking for the person that wants to buy or sell a piece of real estate traditionally. So, any final thoughts?
Yeah. First off, if you were listening to this video and you're like, I don't know what the hell they're talking about, that's okay. I didn't know what any of this meant 18 years ago. And Brandon, you've been in the business 10 years longer than I have. And you and I have talked about it. I mean, you learn this through exercise and participation and information and doing your research. And so if any of this was intriguing to you, do your research, like find someone who's done it, sit down, buy them a cup of coffee or a strong drink, and have them explain to you how it works and ask 100 questions, because that's what I did. I went to the people who were experts at it and I listened. I kept my mouth shut. I did deals with them and I just wanted to learn. I didn't want commission. I just want to learn what you're doing and I want to learn how you're doing it. And I'm willing to participate and I'm willing to help out. You don't have to pay me a thing. My value is I'm learning. And I did that a lot so that I could figure it out so I could do it and earn that value of my own clients. So it starts somewhere.
Well said. So creative financing isn't the last resort. It's a competitive edge. It's about helping clients win when traditional paths don't serve them. So reach out if you want any help structuring your first creative deal. And thanks for listening today. And remember to like, subscribe, and share this episode. And also remember, Chris and I are always affirming your success. Have a great week.